issues or two steps. First of all, that is identify all the expenses incurred during the accounting period and then measure the expenses and recognize them in the same period in which any related revenues earned. So you provide latte to the customer, right? On that latte, the company's incurred costs. For example, cup cost, its cover cost, lightning, whatsoever, salaries, and you just find out that, okay. So sale occurred on 12th of October, right? But you purchased those cups on 8th of October. Right? And this is 2021. In that case, period is same, 2021. So you can just less that. Okay, $30 latte, $10 is the cost of one cup. So $20 is your, for example, there's a cost of something and $20 is your profit. But what happened if you purchased a cup? You purchased cups, and for example, 3 cups, 3 units, and this is in 2021 December, right? And you sell 2 latte in January 2022. Now here comes, there's a conflict. What? You purchased these cups in 2021 December and you sale occurred in 2022. So now question is whether the cost of these 3 cups would be less from the income statement in 2021, or whether the cost of these 2 extra cups, because 1 cup is already sold in 2021. So that makes sense, okay, because the period was same, but it would be, biased. You would be biased if you charge all these cost of 3 cups to 2021. Why? Because among these 3 cups, 2 cups are used in the sales of 2022. So you can not recognize these 2 cups expense in 2021, and you will be recognized this expense in 2022 because these 2 latte will be needing these 2 cups from 2021 and to 2022 sales in January. You understand my point? Lotta, Kathleen, Florian, Dijodi?
Yes, I understand.
Coco, Wusion, Ali, Floy?
Yep.
Yes, understand.
Right? So that's what it means here. Right? It's not like that you charge previous expenses to this sales, or you cannot charge future expenses now. Okay? You charge the cost according to that period sales. That's it. Right? So here we go. So the exhibit 3.2 illustrate the expense recognition, sometimes referred to as matching principle. So recognize the expense of a period against the revenue ending Okay, I think this is exhibit 3.2. We don't have this illustration, so I'm just going to ignore that. Do we have? Let me check whether we have it. Okay. Okay, so you can go to your chapter, book chapter, and you can just read it, exhibition 3.2, and you will realize over there that this belongs to that some expenses are paid in cash, other expenses are arise from using an asset such as supplies, which is belongs to some other period. So that's why we are having A part and B part. So I just uh, didn't copy that illustration, so this slide I'm going to ignore that. Okay, our third learning objective is adjust the accounts. So from here we are talking about the adjusting entries. Now, what are the adjusting entries? So adjusting entries are journal entries, like we do debit to credit, and they are made to ensure that revenue and expenses are recognized in the proper accounting period, right? So they generally made at the end of the accounting period, include at least one income statement account and one balance sheet account. Amazing. So let's talk about it. So this is the income statement, trial balance. So all things are happening, transaction occurred, you record it, you make key accounts, and after that you are making trial balance. We call this unadjusted trial balance. Why? Because we did not close the account for the period, for the accounting period. Okay, so we see cash, a normal account, right? Account receivable, supplies, prepaid rent, right? Prepaid rent, land, equipment, accounts payable, unearned revenue, right? So this is June 30, 2014. So we have unearned revenue, we have prepaid rent. The nature is basically expense. Rent nature is basically expense. Revenue is basically income statement account. Revenue, rent, rent also belongs to income statement. But what they are, why they are doing, in trial balance or balance sheet account, because prepaid rent is our asset, unearned service revenue is our liability. So these two belongs to balance sheet. So it means something happened and they will be converted into expense and revenue through adjusting entry. For example, you paid rent, 3-year rent in advance. Sorry about my writing. 3 years rent in advance. 1 year has gone. So in balance sheet, 3 years rent is already mentioned here. So it means from balance sheet, it must be reduced. So you cannot just reduce that, okay, it is 1000, you can reduce that. No, you need to make an entry. Everything is done through journal entry and posting, and then you post in ledger, and then from ledger it goes to trial balance, and from trial balance it goes to financial statements. So there is an order. You cannot just change like this, okay, it is, you cut the figure and you write it down 1000 here. You cannot do that. If you do that, this is offense, this is punishable, this is crime, right? If proved that you did it by with intentional motive, fraudulent motive, or through your mistake whatsoever, it is punishable, right? So adjusting entries are of three nature: deferrals, depreciation, and accrual. At the end of the period, you didn't know that how much machine and equipment I have used, right? You make a T account, and then after the trial balance, when the period ends after 12 months, and then you realize that, okay, this machine this year wear and tear is like 3,000 or 2,000 or whatsoever, and then you write it down there. But you need to make an entry. So that is called adjusting entry. After the adjustment, then you close the account, and when you close the account, then you are able to make financial statements, right? So many of the students, they are confused. What do we mean by closing the account and adjusting the account? So I'm just going to give you, the explanation that closing mean whenever you find out the balance, right? So this balance is called closing. That's it. So that balance will go to balance sheet. But for, balance sheet and income statement. But for balance sheet items, their balance will exactly move on to balance sheet. If we have a cash here, cash has 3,000, so you write it down on balance sheet 3,000. But if the account belongs to expense, then expense will go to income statement and it will perish, right? Because that expense is for 1 year. So look at the first line of the income statement, that income statement for the year or during the year. So during the year we paid salary this much. We paid it, done. Salary account is closed. And now new salary account will be opened for the next year. But does furniture account closed? It means that we don't have any furniture, we don't have any building, we don't have any cash, we don't have any customers or something. So balance sheet items remains, but expense and revenue will be closed so that we can find out net profit and net income, right? Otherwise we cannot find out what is the net income and what is the net loss or net income, because we don't have the correct figures of sales and expenses, right? Because we will be closing our expense account. Okay, this much expense happened during the period, not above, not less, exact figure. So that is our closing figure, and then we put it on our income statement, and that is our revenue. Okay, and then you less from the revenue the expense, and you find out it is an income or a loss, right? So in order to go to the income statement, before going to the income statement, financial statement, you close the account, right? Through adjusting entries. So let's just talk about this. So a deferral is an adjustment for payment of an item or receipt of cash in advance. So deferrals are prepaid expense and earned revenue. It